Well, hello, everybody. This is commercial week 3. This is being recorded in my office today. And since there's no audience for this one, I hope to go through this stuff pretty quickly. For those of you who are re-watching this video, you'll notice that there'll be a few changes from what we talked about last week because this is a re-recorded video. So enjoy, sit back, enjoy, and hopefully it'll make some sense to everybody. So the first thing we're going to talk about is the homework that was assigned in week 2. In week 2, I gave four different scenarios that you had to look up the clauses for, 4 different ideas that you could put into Schedule A, and you had to find the clauses. Admittedly, it was not an easy assignment. The whole idea was to get you into either web forms or transaction desk to try to find the clauses. The problem with both transaction desk and web forms, and we will take a look at transaction desks in this next slide in just a moment. The problem with these 2 programs is that they are not intuitive at all. And they certainly do not have the algorithms that something like a Google, that's, let's face it, is pretty good when you put in a search for Google. It usually comes up with the top 3 or 4 answers right off the bat. It's really good. The problem with web forms and and transaction desk is that when you put in a different search pattern for the same idea, then there's a problem. For example, the first one here, for assignments, if you put in the word assign in web forms, you get 35 responses. If you put in assignment, you only get 17. And if you put in assignments, you only get 4. And so it's really difficult if you put in the assignments, because that's what you want to find a clause for. You're only getting 4 results, and the chances that you find the result that you want is very slim. Same if you're doing some kind of rental, whether it's a commercial or a residential lease. If you put in the word rent, you get 110 responses. If you put in the word rental, you only get 30. If you put in rentals, just with an S at the end, you only get 4. So it is not a friendly system to work around. And if you put in something like rentals and you don't find the answer, then try something else. Try rental or try rent. Tenants, same thing. Tenant, if you just put in tenant, 135 responses, my goodness. If you put in tenant to, as in tenant to do something, you get 15. And if you're specific, you get 1. Same for these ones as well for home inspections. Another one I want to point out that's very, very unfriendly to use is grammar. Sublease, if you write in sublease, you get 1 response, okay? You get C507. If you write in sub-lease, then you get leasecom 13. You get 2 totally different answers here for basically the same question, just a grammatical change by having the dash in here instead of no dash over here. So you have to be really, really, really careful about how you are searching. And I know a lot of agents get frustrated. They call the managers, myself, whoever, and say, I just can't find a clause. How do I find the clause? And, we certainly have a better chance of trying to find it than you guys do. Because we have a better idea of how to search, because this is what we do for half the day. And so don't hesitate to call us and ask. The other important part I want to point out to you is that commercial and residential clauses or conditions are totally interchangeable. And so, for example, back to inspections, okay, you can put in home inspections and get 3 results. This is probably a residential result because it says home, all right? Can you use this clause? Yes, you can, but you have to change home to something like property, you know, building inspection. You don't want to put home in a commercial offer because, you know, you're probably not buying a home for your client or selling a home for your client. You're selling a building or a property that has a commercial component to it. The other one is rentals. You can certainly, you know, use rentals, or you can use tenants. But sometimes in the tenant clauses or rental clauses, it says that the tenant agrees to obey the rules, not obey, but follow the rules of the Tenancy Act. Well, wait a sec. If you're in commercial, you would have to change that to the Commercial Tenancy Act. So yes, you can interchange the conditions or clauses between residential and tenancy. You just have to be sure that you are reading the document well enough that you have said the commercial component instead of a residential component. Transaction desk. Transaction desk has the same problem as web forms. When you're in transaction desk searching, you can try assign, and it has 11 responses. Assignment has 7. Assignments has 1. Rent 32 responses. Rental 10 responses. Rentals 1 response. In inspect, you have 27. Inspections, you have 4. And believe it or not, when you're in transaction desk and you look at home inspection, it has 0. Oh my goodness. So really, really, really not easy to navigate around the clauses and conditions. You have to get it a little bit creative in what you're searching for, and try to think outside the box when you're looking for clauses or conditions. These are not, you know, really, really smooth and easy like a Google search. So be careful. Most of the clauses that you want are in there. You just have to do a little more searching to find that clause. Of course, you can, once again, you can always call your manager, and hopefully they have some suggestions for you. Even sometimes the front desk can help you find something. You know, if you want, you can try them as well. Last week in in Commercial 2, I introduced you to return on investment. Return on investment is how you manipulate a income statement so that you can find out actually what the return on investment is. So you have 2 things. You have your capitalization rate that should give you an indication of the return that you get as a measure of risk. Remember, capitalization rates are a measure of risk. If you have a 20% capitalization rate, I can tell you right now, it is a risky business. If you have a 2% capitalization rate, it's probably wrong, because there's virtually 0 risk investing in a Canadian government bond. Why would you buy a business that has a 2% capitalization rate when you have some risk at all? And so, you know, the price is too high. I think we've gone through that enough, and I think we've beat it to death. And so I'm not going to go a lot back into the risk factor of capitalization rates. The important thing is return on investment. You know, that's fine to be able to determine a risk and what it might be, you know, as a general ballpark return, if you're lucky and can get that return. But what do most people do? So we're going to go through a few examples with a different down payment to give you an idea. Last week, we talked about adding a truck to a business to get a return on investment, adding an employee to a business to get a return on investment. But what happens if down payments change? So the cash buyer in this example, in example 1, $1 million business, cap rate of 7.5%, net operating income of $75,000. The cash buyer might maybe receive $75,000 per year in revenue. Remember, it is not guaranteed money. All right, it's risk. 7.5 is not bad. But what happens if they change the down payment? In other words, you're not a full cash buyer anymore. So let's look at this. You have $1 million cost of business. You have a cap rate of 75%, of 7.5%. If your investor, I should say, only puts $250,000 down, you have a $750,000 mortgage at 6% per year with a 25-year amortization and a 5-year term. That's $4,800 a month payment. Okay. You now have $6,250 per month. What you should be getting here, 75,000 divided by 12 is 6,250, minus 4,800 is 1,450. Your NOI is reduced to 1,450 a month, times 12 months is 17,400. Well, that NOI is not so great anymore, is it? And if you would put this into your $1 million, well, it's ridiculous. But you can't put it into the $1 million. You can only put it into the amount of cash that they have put down payment. In this case here, they've put down a $250,000 down payment. Their return is still 7%, pretty close to the 7.5%. Not bad, right? You can't look at the 17,400 as a return on $1 million because they did not put down $1 million. They only put down $250,000. So what happens if they put down more money? Once again, your cap rate is 7.5%. Now you put down half, 500,000. And by the way, mortgages for commercial, you have to put down 25% or more often. 20% would be the absolute lowest. 25% would be more normal. 33% is even perhaps more normal. But if someone puts down $500,000 at the same interest rate, 25 years, 5-year term, $3,200 a month payment, your NOI is reduced to $3,050 a month, and 3,050 times 12 is 36,000. Well, 36,000 is not a great return on $1 million, but once again, you can't do that because what you have to do is they've only put down 500,000. And so 36,000 divided by 500,000 is a 7.3% return. And once again, if you do a little bit more, $750,000 down, your return is 7.4%. And so investors really do look at this kind of thing very, very, very carefully. Geez, if I put down all my cash of $1 million, I'm going to get a 7.5% return. Okay. Instead of doing that, though, I'm only going to put down 500,000. I'm going to be really happy with my 7.3% return. That's really close to the 7.5, let's face it. And what else can I do with my other $500,000? And this is what investors look at. And if you recall back to the first commercial session, we talked a lot about opportunity cost. And opportunity cost is what you could do with something instead of doing something else, I guess. I know that sounds a little bit funny, but instead of putting down $1 million and getting 7.5%, you can put down 500,000 and get a 7.3% return on his 500,000, and maybe take the other $500,000 and then buy a government bond with the other 500,000 and get a 3% return. And so overall, he's going to get, something safe at 3%. He's going to have a little more risk at 7.3%. And that is what is called diversifying your portfolio. And that's what people do. People don't all go in and buy, $100 million properties and get a good return on that one. They diversify. They buy $10 million properties and $5 million properties and $1 million properties, and they put some money in stock markets, and they put some money in government bonds, and they put some money into TFSA accounts, and they put money, into just about anything they want, some high risk, some low risk. And this is how they spread their risk around a little bit, so they're not all in high risk stuff. And so when a client says, Well, if I only put $500,000 down on $1 million property, what's my return? This is the calculation that you have to figure out, okay? In just about all the examples, the original cap rate holds true no matter what the mortgage amount is. The difference was between 7 and 7.5%, only a 0.5% difference with this kind of scenario for interest rates. Why interest rates are so important. On the residential side, of course, we watch interest rates like hawks because certainly, as we are all experiencing today, the low interest rates that we're into right now, and my goodness, they're historically record low interest rates. We watch them because, number one, we own houses. And if you're paying a mortgage, the lower the interest rate, obviously better. And also from a real estate perspective, low interest rates drive the real estate business as what we have, just as what we have experienced in the last, let's call it the last 4 or 5 months. The low interest rate has certainly driven the craziness in the real estate market today on the residential side. So what happens with interest rates when you have commercial? Well, let's do the middle example here. Look what happens here if the interest rate for your commercial goes to 8.75. And if you recall from the previous example, the interest rate was 6%. So it's going up 2.75%. My goodness, that brings your monthly amount to $6,200 in a monthly payment. Your NOI is only $50 a month. $50 times 12 months is $600 is your new NOI. Oops, $600 divided by 500,000 is only a 1.2% return. No one's going to buy this anymore with this kind of an interest rate, with this kind of a down payment. Why? Because I can take my $500,000 and I can probably get a much better return from a government bond. Remember, if it's 8.75% for a commercial rate, it means that interest rates have gone up, which means returns on bonds, other investments, RRSPs, that kind of thing, are going to be higher as well. No one's going to do this, all right? And so do keep in mind interest rates. It really, 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 really is important. The buyer will look very, very closely at interest rates. If the interest rate is high, the NOI drops and the return drops proportionally. Plus, if you recall from quick start, gotta stop saying that, from the commercial 2 session, any additional expenses that the buyer feels that they have to do will also drop the NOI, which in the buyer's mind drops the value of the business. And it's not just in the buyer's mind, it's in the buyer's pocketbook, and it's true, okay? So you do have to be very, very careful and know your interest rates really well for a commercial business. Now, what do some buyers do? Without any question at all, some buyers buy businesses because they love it, okay? It's called the love factor. And guess what? That happens in residential as well. No matter how crazy or whatever your residential buyer is doing, the love factor sometimes kicks in, you guys. They can't resist the temptation to buy regardless of the monetary facts. Most of the time in a commercial setting, they feel they can increase the value of the business. So an example of that is somebody buys a bakery. The bakery has a terrible net operating income. Maybe it's really, really bad because they make bad stuff. Well, you know what? Maybe the buyer wants to buy it because they're a better baker and they just want to go ahead because they feel that they can improve or increase the bottom line of the business. Sometimes it's simply a hobby that people do. They buy little restaurants and stuff, and they run a good mom and pop shop for a few years, and it gives them something to do, and they might make a little bit of money on the side. The other part, of course, is the cash business, and we're going to talk about that a little bit. But the bottom line is let the buyer decide. Don't talk a buyer out of doing something. If the buyer really wants to do it, then let the buyer do it. You have to take the appropriate steps, of course, and make sure that the buyer's getting legal advice or accounting advice, right? It's not your decision to try to talk a buyer into, it's almost worse to try to talk a buyer into a property that they don't want, or talk a buyer out of the property. If the buyer really wants something, then make sure they get professional advice, okay? And, then you've covered yourself basically, right? It's the same as residential. I would think that most of you listening to this are giving your clients advice by telling them to get a home inspection and telling them to get a financial condition waived or mortgage financing. You're not telling your buyer in a residential setting that the house is fine, right? And just the same thing as you should not be telling a buyer in a commercial setting that the income statement is fine, that everything looks great, okay? Financially, it looks wonderful, right? No, you are steering them to a professional to make that final decision, or else it might come back and bite you. Let the buyer decide, okay? Do not let, for those of you who listen to this and have been in my quick start lessons, it is very, very obvious that I say let the buyer decide, but I also say don't let your personal taste influence the decision of a buyer. Let the buyer decide, okay? Just keep that in mind, the love factor. Moving on. So there are 3 different types of businesses in Ontario, actually basically in Canada, out there. A sole proprietor. A sole proprietor, you guys are all sole proprietors. In the real estate business, you're all sole proprietors. Now, some of you, you file taxes as part of your personal income tax return. That has changed now because some of you will become owners of your personal real estate corporations, your PRECs. However, in that PREC is a place to park commissions, all right? You can't hide behind a PREC in terms of liability, okay? In the government's eyes, you're still sole proprietors. However, you have a PREC as a shelter for money, all right? So a little bit different. You're still liable under your errors and omissions insurance, just like you are now, even if you own a PREC. So consider yourself as a sole proprietor. If you have a PREC, congratulations, I guess, but you're still sole proprietors. Partnerships. Partnerships are becoming less and less common in Ontario today. I don't know about the rest of Canada, but it frowns on formal partnerships because of the complexity involved in the dissolution of the partnership. There's some really weird and wonderful rules about partnerships out there, and it is beyond the scope of this training session, and I'm not going to talk about it anymore. It'll be very, very, very rare in commercial today that you will find a buyer well, actually, you'll probably have a better chance of finding a seller as partner because it was, set up as a partnership years and years and years and years ago. Most people today do not do partnerships. Ontario really frowns upon it. And most people today will do corporations. Corporations are really common in the commercial world. A corporation could have a short form of a corp, an Inc., or a limited. So that's a corporation, an incorporation, or a limited. They all have one item in common, and that as a minimum, there is one share owned by somebody. All right. The owner of the corporation is a shareholder in the corporation. If there's one person, they have at least one share. They could have 10 shares. They could have 20 shares. They could have 1 million shares. That's up to the person who has set up the corporation and their accountant and what they are doing. All right. Every corporation has a board of directors. That board of directors may only be that one person. All right. Board of directors, I think for something like a Bell Canada. Bell Canada might have 18, I have no idea, 18, 16, 20, 24 people on their board of directors. They might only have 10, I have no idea. I don't know that too many board of directors have more than maybe a couple of dozen. I don't know if there's a cap on the number of board of directors. The thing is that it's either one or more board of directors and those people make decisions affecting the corporation. I don't think anybody at this stage of your real estate career are going to run into corporations with 20 or 25 or 15 board of directors. You're usually going to run into 1, 2, or 3. And often that 1 or 2 is the husband and wife team where they own 50-50 shares in the corporation. They own 1 share each. Maybe they own 5 share each, however it's set up. Sometimes there's 3 people set up a corporation because they had a business idea. Yay, it was a great idea. There's 3 different people as shareholders, and now they want to sell the property, okay, or business. All right. The board of directors, whether it's 1 person or more, keep what is called minutes. It's the minutes of the corporation that record what is happening in terms of operations. All right. The minutes are what the board of directors have decided. Okay. So in the case of 1 person, technically they should be keeping minutes, and in that book, and it's called a minute book, it is recorded that, for example, the seller wants to, the sole shareholder of the corporation wants to sell his business. All right. If you have more than 1 shareholder, then the minutes would say in the meeting of such and such a date, it has been decided that this person can act on behalf of the corporation to buy or sell. Okay. And it's recorded in the minute book that they are naming a person that has the right to sell the business or whatever they're selling, property, whatever it might be. If it is a 50-50 shareholder, then both people have to sign unless there is minutes that directs 1 person being able to sell the corporation. People run into corporations in the residential world as well. Why? Because there's lots of people who have invested in residential real estate for the purpose of leasing it out to tenants. Let's face it, lots of condos have lots of tenants, and most of those are owned by corporations. Why? Well, there's liability purposes for sure, tax purposes as well. And if you as a real estate professional are representing a seller, and the seller is a corporation, you are required to get the Articles of Incorporation. The Articles of Incorporation are who has the right to sell the property. If there's only 1 shareholder, it's very obvious. If there's a bunch of shareholders, then you need to see the minutes of the corporation where they have named somebody to act on behalf of the corporation that can sign for the corporation. And without that, you cannot continue on. With a buyer, if the buyer is a corporation that's buying, same thing. If the buyer owns the corporation and it's only 1 shareholder, well, then obviously they have the right to do it. If there's 2 or more and it's not a 50-50 split, then you need to see the minutes of the corporation, that you see who has the authorization to bind the corporation, or else you need everybody signing. So if there's 5 people who are shareholders, then all 5 people need to sign the purchase and sale agreement or a listing agreement. And yes, you have to be able to squeeze everybody's signatures onto the signature page, or you can put in the signature page, you can put please see schedule, I don't know, B, C, D, E, whatever. And you can call that a signature page, and you can put everybody's name and date and get everybody's signatures on a signature page. So be careful with the corporations. You have to be sure that the person signing has the authorization to bind the corporation. Sole proprietor advantages. Sole proprietor advantages. The advantages are they're simple to set up. You can start a business easy. You guys have all done it as real estate professionals. You've all got your license and you called CRA, you got a business number, and you're away to go. Simple tax rules. You're taxed personally, just like you are if you're at a job and getting paid. It's virtually free to start. Well, to get your license cost you, well, depending how old people are here, between three and, two, three, four, $5,000. And a huge advantage of a sole proprietor is that you are in full control of your business. All right. No one's telling you what to do. You are in full control. You're the person who signs the checks. You're the one that makes the deals. You're in control. Disadvantages. The number one disadvantage by far is exposure to liability. In real estate, thank goodness, you're covered in your errors and omissions insurance. And if you were running a shoe store, you better have insurance in case somebody buys a shoe from you and breaks a leg as they walk out the door. You do have exposure as a sole proprietor. Harder to raise capital. It's hard to walk into a bank and borrow money as a sole proprietor unless you have money. When I was running a business, I needed to buy a quite expensive asset, and I went to the bank, and I won't say which bank it is, but I went to the lending officer, the commercial lending officer of that bank, and I tried to raise money to purchase an asset from the bank, and I kept getting turned down. And I said to the loans officer, well, under what conditions can I borrow money to buy this asset? And he said to me, he said, basically, John, you need to have that amount of money in the bank before we will lend you any money. And I looked at him and I said, if I have that amount of money in the bank, I could buy the asset and I wouldn't have to borrow money. It doesn't make sense. So as a sole proprietor, it can get difficult to borrow money. Usually long hours are involved. You're by yourself. You're the person in charge. You're personally liable for all debts. Self-employment taxes may be slightly higher than corporate taxes. And by slightly higher, I am saying just barely higher year in, year out. If you have a personal real estate corporation and you have money in there on December 31st, you're only going to pay corporate tax on it, which is lower than personal tax. If you take that money out on January 1st of the following year, the government catches up with you and there might be a minuscule savings of taxes, but it's virtually no difference at all. Difficult succession issues. When you die, guess what? Your business dies with you. And real estate's a great example. If I'm not saying, I don't mean to say that anybody should die here, my goodness, but as an example, we're talking about succession. In real estate, if one of you guys die today, what happens to your real estate business? Well, basically it dies with you. And so it is difficult to pass on a business when you pass as a sole proprietor. You'll see I jumped right to corporation here. I'm not talking about partnerships. Corporation advantages. You're not personally liable in a corporation with some exceptions. And one of the biggest exceptions is environmental degradation of a property. You have to be really, really careful about environmental, even with a corporation. You can't just go polluting the land all around you and not be responsible. Even if you're in a corporation, you can't hide behind that. Board of directors and CEOs of large corporations, for example, in the Alberta oil sands, all have that kind of insurance, so that if somebody decides to sue them because of environmental, maybe the government even would decide to sue them, they have insurance that will protect them personally, so that they are protected in case of environmental. Another example is a board of directors of a hospital. The board of directors of a hospital may be personally liable if it's run really, really poorly, and I would assume lots of deaths or something like that. And so they all have insurance as well. So you do have to be, most of the time you're not personally liable, but there are some exceptions to liability in a corporation. It can be easier to raise capital in a corporation. How? Well, you can sell shares. It's easy to transfer ownership. You can sell shares in your corporation, and it can be perpetual for life because you can will, in your will, you can will your shares to your next of kin or your friends or your cat or, whatever you want to do. Disadvantages. There can be difficult tax rules in corporations. And for those of you who have a PREC, you're going to find that filing corporate income tax is really, really difficult. Dividends may be taxed personally depending on what you're doing there. So be careful if you're going to do a PREC. My goodness gracious, talk to an accountant first. The board of directors can operate the company with little oversight from shareholders. I doubt that any of you are going to run into this problem, but a good example of that, go back to Bell Canada. Bell Canada has millions and millions and millions of shareholders out there. And 12 people are running everything. And the shareholders don't have a lot of say in what's going on. So you do have to be careful about that. I don't think that's going to apply to most of you. Cost of formation can be expensive to set up a corporation, especially if it's a complicated corporation where there's all sorts of different classes of shares. Once again, that is beyond the scope of this course. And so if you're going to do a corporation, and particularly if you're going to do a PREC, talk to an accountant. If you are working though with sellers and buyers that have corporations, you do have to be very, very careful to make sure that the person who is signing or people who are signing on behalf of the corporation, whether they are buyers or sellers, have the authority to bind the corporation. And like I said earlier, that's done by looking at the articles of incorporation. And if it's not clear there, then you have to look at the minutes of the corporation where it's being recorded who has the authority to bind the corporation. Types of sales. All sole proprietor sales are asset sales. An asset sale will include the chattels in the business and may or may not include the name of the business, internet address, et cetera, may include property as well. This sale is affected by capital gains and possible HST on qualifying chattels. We're going to talk about capital gains and HST in just a minute. Corporation sales can be asset sales or share sales. In other words, a buyer can buy all the assets of a corporation and basically remove them from the corporation name, or you can buy the shares of a corporation that includes everything in the corporation, all right? Either way, the buyer is purchasing the business. It is the structure that is different. Advantages and disadvantages. Share sales, advantages and disadvantages. When a buyer buys the shares of a corporation, all liabilities pass to the new owner, including, by the way, on a small scale, the environmental problem. So it can be huge by buying shares. You want to make sure that if it's a standalone building, what is it being used for today? What is it being used for in the past? And that there's no environmental problems, okay? But all outstanding liabilities, not just environmental. If you buy all the shares of a corporation and the seller still owes money to the government for employee remittances, as an example, then guess what? The buyer is now responsible for it. So you have to be really careful about how you structure a share offer, that the liabilities have been taken care of, and that the buyer's lawyer has an idea of how to do that. You would not do a share sale to your buyer without a really, really good real estate lawyer who has done these things before. You're not going to just have a lawyer that is just a family lawyer that does divorces, right? That's not the kind of legal advice your buyer needs if they are doing a share purchase. There is capital gains exemptions out there. I think actually it's gone up. I had this slide made last year. I'm not sure if it's gone up or stayed the same, but I think it's gone up a little bit. But there's lots of rules. The rules for capital gains and having that $800,000 exemption is the size of a small book, like this thick, an inch thick, kind of book on how this stuff works. That is way beyond the scope of this course. And you want to, maybe talk to your buyer about how they are setting up a purchase in terms of capital gains exemptions. Down the road, it's beyond us, okay? Seller advantage is in ease of sale because it can avoid land transfer tax and may avoid some portions of HST on equipment. Now, it can avoid land transfer tax if it's a straight up business. If there's property involved, and property is a major part of that corporation, there's once again a very, very, very big book on how to calculate land transfer tax for corporations. That's beyond the scope of this course. Make sure your buyer's getting accountant advice, okay? There's a little less effort, there's lower risk. It's easy to maintain existing suppliers because they just keep supplying ABC Incorporated. They just, it's a restaurant, Coca-Cola's, going to ABC Incorporated, it's still going to ABC Incorporated. There's no change of name kind of thing. Employees have to be let go and then rehired. It's really quite a simple process. Customers may not even know that the business has changed hands because most things stay the same. The disadvantage, everything goes with the business, including the name, internet, et cetera, et cetera, et cetera. There'll be guarantees that the seller can't open up another business of any kind of sort, that kind of thing. And back to the liabilities passing to the new owner, the disadvantage to the seller is it may require extensive warranties. It may even have personal guarantees that if something comes up out of the woodwork 6 months later, the buyer can go after the seller of the corporation personally to take care of that liability. So there are some disadvantages as well. It's interesting. I've seen a deal recently where there was a personal guarantee put forward from the agent to the seller, from our buyer agent to the seller, that had a personal guarantee clause. And the seller crossed out the personal guarantee clause. Now, what does that mean? Well, the reason why there's a personal guarantee in there is that on Schedule A, is that if the buyer finds a month or two down the road that some liabilities haven't been paid for, then they can go after the seller under the personal guarantee. So what does that mean if the seller crosses out personal guarantees? Well, gee whiz, Mr. Seller, are you saying there's still liabilities in the closet that we haven't found yet? Why would anybody cross that out unless they thought there was something out there? So be careful about personal guarantees, whether you're on the selling side or the buyer side. Personal guarantees can be a tricky thing. HST. HST is charged on most commercial sales. There are some exceptions. Some medical offices or businesses may not have HST because HST is not charged on medical services. An example of that is let's call it a wheelchair service. All right. If you go in and buy a wheelchair, you don't have to pay HST on that wheelchair. Okay. As a result, the business is not subject to HST. But most of the time, HST is charged on commercial sales. It's in addition to. Okay. HST is charged to the seller. It's the seller that must pay HST. When you have a sale that says the buyer has to pay HST, is the buyer actually paying the HST to the government? And the answer is no. The buyer is paying the HST to the seller, and the seller is responsible to remit the HST to the government. Okay. And here's what you want to do. When both buyer and seller are HST registrants, the HST is flow through. What does that mean? That means that the government, and I have to say, the government in its wisdom has decided that if both the buyer and the seller are HST registrants, the buyer and the seller sign a bunch of documents and the buyer does not have to pay in cash HST to the seller, and the seller does not have to pay in cash to the government. How would it normally work? Well, how it would normally work is that the buyer would pay the HST to the seller would remit it to the government, and then what could the buyer do? The buyer could claim an input tax credit, an ITC, that all of you should be familiar with as sole proprietors, and you're all HST registrants. You should all know what input tax credit is. If you don't know, then Google input tax credits, and you will find out very easily what they are. But the buyer could submit an input tax credit and get his money back in 3 months. Well, that's a lot of extra cash flow, and the government has decided, no, you don't have to do that. If you're both HST registrants, you're purchasing a business that is HST registered, you're an HST registrant, just sign these papers here that you're the registrant, that the seller's the registrant, and it flows through so that the buyer does not have to actually put out cash and the seller does not actually have to put out cash. There are some little tiny rules in there that this does not work through, and it's called a buyer self-remittance. And once again, an accountant needs to be considered here, or a lawyer should know about HST. A good real estate lawyer would know about HST and how that works. And you want to be sure that your buyer and seller are getting legal or accounting advice when it comes to HST. When a seller is an HST registrant and the buyer is not, HST is in addition to, right? And so then your buyer now has to put out cash. So we advising, I know other managers here, and certainly myself, a buyer is buying a restaurant under his personal name. No, what are you doing? Become an HST registrant, get a corporation. You need it for liability when you run a restaurant anyways. And so why don't you get it now? Certainly your lawyer is going to advise the buyer to do it. You should perhaps advise the buyer to do it, but of course they should always check with their lawyer or their accountant. But if the buyer becomes a registrant prior to the completion date, then HST is going to flow through and not be in addition to. Form 500, Section 7. Form 500 is the agreement of purchase and sale for a commercial, okay? There's also Form 501, which is condos, and 502, which is, I believe it's assignments, I think. Can't remember off the top of my head. But it is in here in the pre-printed portion of the agreements of purchase and sale already is in there about HST, all right? There is no spot like on a residential agreement that talks about in addition to or included in. It is here already. And what I have just talked to you about here, about flow through, is all here. Okay, so I'm not going to read this whole thing. All right. The point of me bringing this up is that you should be aware of never, ever, ever putting HST as a statement, a clause, a condition, anything like that in Schedule A because it's already in the pre-printed portion of the agreement of purchase and sale. If you recall from your schooling, if you put anything into Schedule A, it overrides the pre-printed portion of the agreement, and you don't want to be overriding the HST clauses. The lawyers in the province of Ontario for RICO and AREA and government have worked hard at making this clause. Do not write anything into Schedule A because you're going to overwrite what everybody agrees is the right thing already. Capital gains. When you are representing the seller of a commercial business, you must talk about capital gains to that person, okay? As a matter of fact, you should talk about capital gains when you're doing an assignment sale, because if you're representing the seller on an assignment sale, the profit they make on an assignment is subject to capital gains, okay? It's a profit a business makes when it sells its assets. It's easy, okay? Capital gains are calculated by determining the profit made, which is determined by the sale price minus the purchase price. Okay, so somebody bought a business for $50,000. I'm making this easy here. $50,000. They sell it for $100,000. They have a capital gain of $50,000. Now, you can reduce your capital gain by having some qualifying expenses, capital expenses into your business. But we're going to keep it simple here. $50,000 purchase price, sale price of $100,000. You have a capital gain of $50,000. Okay. 50%, how is capital gains calculated? Capital gains is calculated by doing 50% of the capital gain. So 50% of $50,000 is $25,000. That is the amount that is taxable. So $25,000 is taxable. If your tax rate is 40%, that $25,000 times a 40% tax rate is $10,000. That 40%, we call that the marginal income tax rate. All right. I'm just putting in 40% as an example. All right. If the seller is selling a business on January 1st and will not make any more income for that year, the seller's not making any more income. He sold it January 1st. His marginal income tax rate is probably going to be closer to 20%. Okay, because he hasn't made any other money. Maybe he's made some money and his marginal income tax rate is 30% or 32% or 28%. We really do not know what it is. This is just an example so that you guys can help a seller roughly figure out what the capital gain is. The rough rule of thumb, okay? The rough rule of thumb is that you have a 20% tax payable on your capital gain. In other words, your capital gain is 50,000, you have to pay 10,000. Your rough rule of thumb is that it's 20% taxable. Okay. If the 50,000, if they purchased it for 50,000 and the sale price was 150,000, their capital gain would be 100,000. They probably would have to pay about $20,000 in taxes, roughly speaking, just ballpark, just trying to show you how it works. Capital gain calculations are calculated after real estate fees, commissions, and lawyers' fees or commissions, okay? As well, once again, you can reduce your capital gain by subtracting capital expenses. Okay, so all good questions for accountants, okay? But you should definitely make sure that if a seller says, do you know, I bought my place for 50,000, I think I want 100,000 for it. I want to make 50,000. Well, wait a second, Mr. Seller. Have you considered capital gains? Okay, you want to make sure that they are aware of the capital gain. Back to assignment sales. Assignment sales are subject to capital gains. In most cases, sometimes they're subject to personal income tax because they're doing it all the time, but that's a different story. You know, if you're talking to a seller who's doing an assignment sale in a residential deal, you better bring up the subject of capital gains, that if you sell this property for this amount of money, this assignment, this contract, I guess you're not selling the property, you're selling a contract in an assignment sale. If you're selling that assignment sale, how have you thought about capital gains? It's taxable, okay? Be aware of capital gains. If you are representing a seller and to some degree a buyer, you should also be aware of recapture tax, all right? Recapture tax is the difference between a depreciated amount and assigned value. We talked about depreciation in the last session, okay? The seller wants to depreciate equipment for tax purposes. They buy an asset for $100. The government allows the owner of the business to depreciate the value of that asset so that they can write it off against revenue that they have made for income tax purposes. Okay, so let's just say in this example that the seller has a $100 asset and he's depreciated it to $10. In the simple math example and for simple taxes, he has taken that $90 over the years that he's been depreciating. he's been taking $10 in one year and $10 in another year, whatever the scale is. And he has depreciated roughly $90 against revenue, so he doesn't have to pay income tax. Okay, it's a beautiful thing. However, when a buyer looks at buying that asset, all right, and sees that it is being depreciated to $10, and buyers want to see this stuff, he's going to say, well, wait a second, if I buy that asset at $10, I can only depreciate from $10 down, which does not give me any tax advantage. So, Mr. Seller, I want to change that and have the value of that asset at $50. And they can change it. You can change it. Okay. And now the seller says, well, wait a second. I now have to pay recapture tax. And so this seller would now have to pay recapture tax on $40. And he's going to be taxed at his marginal income tax rate to do that. Okay. So I know that sounds a little bit complicated. It's not the easiest. You just need to be aware of these things. As a commercial real estate professional, you should have a basic understanding of, this should have HST in here as well, of HST, capital gains, and recapture taxes when discussing sale prices of a business, and certainly recapture taxes when you're looking at the ownership for a buyer. But profit can be seriously impacted on the side of the seller with these things. You are not an accountant. Tell the seller to get a professional advice. But you need to know about HST, recapture tax, and capital gains just as a rough outline so that you come across as being a professional. Think about a seller thinking about selling his business, and you know what? The sellers probably talked to an accountant already, before they decide to sell. There's a really good chance that the seller has talked to an accountant already. How professional would you look if you talk to that seller and say, what about recapture tax, and what about HST, and what about capital gains? Are you aware of all these things? And the seller says to you, yes, I've talked to an accountant already about it. You know what? You're looking really good in the eyes of that person who is thinking about selling or buying, because you're talking on the same level as he knows about stuff. All right, you're on the same level. So he trusts you because you know what you're talking about. Do you need to be an expert and explain it down to the last penny? Absolutely not. And don't, because you're not a professional in that business. You're a real estate professional. You're not an accountant or a lawyer. And so you guide them, and you guide them well towards the accountant. Last part, homework, due November 11th. And it's considered the advantages and disadvantage of a 100% share sale from a buyer's perspective. Please find 3 to 5 main points of each. And last but not least, our next session will be live. It is on November the 13th. It will be recorded. And of course, the Zoom meeting will be sent out 15 minutes prior. If you are watching this in the next day or two, there is no session on November 6th. And thank you very much. I hope everybody enjoyed that. And I look forward, if anybody is watching this, to see you on November the 13th.